Building wealth is only half the battle. Protecting it is equally important. Markets crash. Economies collapse. Currencies devalue. Without proper protection, years of wealth building can disappear overnight. Today, I'm revealing 7 safe assets that protect wealth during turbulent times. These aren't get-rich-quick investments. They're stability anchors that preserve purchasing power and provide security when everything else is falling apart. Smart wealth builders use these assets strategically. Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave "yes" in the comment, and we are here to help you obtain insight and build wealth. Asset 1. U.S. Treasury Bonds. Treasury bonds are backed by the full faith and credit of the U.S. government. They're considered the safest investment in the world. When markets crash, investors flee to treasuries. Treasury bonds come in various maturities. Short-term bills mature in under 1 year. Notes mature in 2 to 10 years. Bonds mature in 20-30 years. Currently, they yield 4–5% depending on maturity. The safety is unmatched. The U.S. has never defaulted on its debt. Even during the Great Depression, Treasury holders were paid in full. This is why they're called risk-free assets. I keep 10–15% of my portfolio in Treasury bonds. They provide stability when stocks crash. During the 2020 market collapse, my treasuries held steady while stocks dropped 30%. This stability prevented panic selling. Buy treasuries directly through treasurydirect.gov or through ETFs like SHI for short-term or TLT for long-term exposure. They're the foundation of wealth protection. Asset 2. High-yield savings accounts. High-yield savings accounts currently offer 4–5% annual interest with FDIC insurance up to $250,000. They provide liquidity, safety, and decent returns. Online banks like Ally, Marcus, and Capital One offer significantly higher rates than traditional banks. Your money is completely safe, accessible instantly, and earning reasonable returns. This is where emergency funds belong. Not in checking accounts earning nothing. Not in stocks that could crash when you need the money. In FDIC-insured savings earning competitive interest. I keep 6 months of expenses in high-yield savings. This provides peace of mind and prevents forced selling of investments during emergencies. The 4–5% interest is bonus security. Open a high-yield savings account today. Move your emergency fund there immediately. This single move protects wealth and earns better returns than traditional banks. Asset 3. Investment-grade corporate bonds. While riskier than treasuries, investment-grade corporate bonds from stable companies offer higher yields with manageable risk. These are bonds from established companies with strong credit ratings. Companies like Apple, Microsoft, and Johnson & Johnson issue bonds paying 5–6% annually. These companies have decades of stable cash flow and minimal default risk. Corporate bonds provide income and stability. During market volatility, they're less volatile than stocks but offer better returns than treasuries. They're the middle ground of wealth protection. I allocate 10% of my portfolio to corporate bond ETFs like LQD. They provide steady income and moderate stability. When stocks crashed in 2022, corporate bonds declined minimally while providing consistent interest payments. Access corporate bonds through ETFs for diversification. Never buy individual corporate bonds unless investing $100,000 plus. Diversification is critical for safety. Asset 4. Real estate, primary residence. Your primary residence is wealth protection disguised as housing. Real estate historically appreciates 3–5% annually and provides inflation protection. Unlike stocks that can go to zero, real estate has intrinsic value. People always need housing. Even during crashes, real estate maintains significant value and eventually recovers. The psychological benefit is enormous. Owning your home provides security that renting never can. No landlord can evict you. No rent increases. Just stable housing and appreciating equity. I bought my home 5 years ago. It's appreciated 40% while providing stable housing. The equity is protected wealth that grows tax-free until sold. This is wealth protection and lifestyle security combined. Buy real estate in stable areas with strong job markets. Avoid overextending. Keep mortgage payments under 25% of income. Real estate should provide security, not stress. Asset 5. Precious metals, gold and silver. Gold has preserved wealth for 5,000 years. It's the ultimate currency crisis insurance. When paper money fails, gold endures. Gold typically returns 2–5% annually but shines during crises. During the 2008 financial crisis, gold rose 25% while stocks crashed 50%. During high inflation periods, gold protects purchasing power. Silver offers similar benefits with more volatility and industrial demand. It's more affordable for smaller investors and has practical uses beyond wealth storage. I allocate 5–10% of my portfolio to precious metals through ETFs like GLD for gold and SLV for silver. This is crisis insurance. Not for growth, but for protection when everything else fails. Don't expect to get rich from gold. Expect it to preserve wealth during disasters. That's its purpose. It's financial insurance, not an investment. Asset 6. Dividend aristocrats. Dividend aristocrats are companies that have increased dividends for 25+ consecutive years. These are the most stable stocks available, combining growth with income. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have paid increasing dividends through multiple recessions, wars, and crises. They're as close to stock market safety as exists. These stocks provide growing income that protects against inflation. A 3% dividend-yielding stock that increases dividends 7% annually compounds wealth while providing stability. I hold dividend aristocrats as my stock portfolio core. They're down less during crashes and provide income regardless of market conditions. During 2022's market decline, my dividend income actually increased. Build a portfolio of 15–20 dividend aristocrats or use ETFs like Noble. These provide stock exposure with significantly reduced risk. They're wealth protection with growth potential. Asset 7. Inflation-protected securities, tips. Treasury inflation-protected securities adjust principal based on inflation. When inflation rises, your investment value increases. They're specifically designed to protect against inflation erosion. Tips guarantee your purchasing power is maintained. If inflation runs 5%, your TIPS investment increases 5%. You can't lose purchasing power, which is the whole point of wealth protection. During high inflation periods, TIPS outperform regular bonds significantly. They're essential portfolio components when inflation threatens wealth. I added TIPS to my portfolio during the 2021-2022 inflation surge. While regular bonds lost value, my TIPS maintained purchasing power. This protection was crucial during 9% inflation. Access TIPS through treasurydirect.gov or ETFSCHP. Allocate 5–10% of fixed income allocation to TIPS. They're specialized protection against specific threats. Building your protection portfolio. Don't put everything in safe assets. That's too conservative. Balance growth and protection based on your age and risk tolerance. Conservative allocation, age 50 plus, 60% safe assets, 40% growth assets. Moderate allocation, age 30-50, 40% safe assets, 60% growth assets. Aggressive allocation, age 20-30, 20% safe assets, 80% growth assets. Within safe assets, diversify across all 7 categories. Don't concentrate in one protection method. Each protects against different threats. My protection portfolio: 15% treasury bonds, 10% high-yield savings, 10% corporate bonds, 30% primary residence equity, 7% precious metals, 15% dividend aristocrats, 3% tips. This totals 90% of my net worth, with 10% in growth stocks and alternative investments. Rebalance annually. As growth assets appreciate, sell some and buy more protection assets. This locks in gains and maintains proper balance. When to emphasize protection. Increase safe asset allocation during late bull markets when stocks are expensive, high inflation periods when purchasing power is threatened, personal uncertainty like job changes or health issues, approaching retirement when you need stability. Decrease safe asset allocation during bear markets when stocks are cheap, early career when time horizon is long, stable personal circumstances with secure income, confident economic periods with low inflation. I increased my protection allocation significantly in 2021 when markets hit all-time highs. This positioned me perfectly for the 2022 decline. Protection assets held steady while growth assets crashed. The psychology of protection. Safe assets feel boring. They don't double overnight. They don't have exciting stories. But they do something more important: they let you sleep at night. Wealth protection isn't about maximizing returns. It's about minimizing regrets. It's about having stability when chaos erupts. It's about preserving what you've built. I learned this the hard way. In 2008, I had no protection assets. When markets crashed, I panicked and sold at the bottom. Pure growth allocation seemed smart during the boom. It was devastating during the crash. Now I prioritize protection. My returns are lower during bull markets. But I sleep well. And I don't panic during crashes because my protection assets provide stability. Common mistakes to avoid. Don't skip protection thinking you'll time the market. Nobody consistently times crashes. Protection is insurance. You need it before disasters strike. Don't over-concentrate in one safe asset. Treasuries protect against stock crashes but not inflation. Gold protects against currency crises but doesn't generate income. Diversify protection. Don't let safe assets sit uninvested. Even protection assets should be optimized. Use high-yield savings instead of checking accounts. Use treasury ETFs instead of cash under the mattress. Don't ignore rebalancing. Annual rebalancing forces disciplined selling of appreciated assets and buying of undervalued protection. This is systematic wealth protection. Conclusion. Building wealth requires taking risks. Protecting wealth requires reducing them. Smart wealth builders do both. They take calculated risks with growth assets while maintaining protection assets for stability. The 7 safe assets I've shared protect against different threats. Treasuries and bonds protect against stock crashes. Real estate and tips protect against inflation. Gold protects against currency crises. Dividend aristocrats provide income stability. You don't need all 7 immediately. Start with high-yield savings for emergency funds. Add treasury bonds for stability. Gradually build a diversified protection portfolio over years. If this video showed you how to protect hard-earned wealth, hit that subscribe button for more wealth protection strategies. Comment below with which safe asset you're adding first. Remember, making money is exciting. Protecting money is boring. But boring wealth protection is what separates those who stay wealthy from those who lose everything during the next crisis. Protect what you've built.